I think, Tom, for me, the unemployment rate ticking up to 4.6, as we said in the preamble. I think that's going to get attention of investors and policymakers. I think you see that move in the bond market already. After that, I quickly looked at your non-farm payroll. I mean, I guess on a positive note, if you want the West Coast optimistic spin, you did have a negative October, but total private, if you exclude the government payrolls, didn't look too bad, Tom. You're talking about 52,000 in October. You're talking about 69,000 in November. You mentioned the 3-month average. We do like to look at that as well. And the Bloomberg economics team absolutely right. That 22,000, that's total non-farm. If you look at just private, it looks a bit better. It's 75,000. So
right.
I would still characterize that as soggy, to steal your phrase, your reference for retail sales. And I still think the risk here is a higher unemployment rate. And so I think this brings the Fed already back into play. We've got a lot more data before the next FOMC meeting, but I think the bond market will react, if I'm not mistaken.
I'm going to go to 3-month average. But Jeffrey, with your study at Claremont of politics, a 75,000 private statistic or a 22,000 non-farm payroll 3-month average, I don't care what flavor you are, Jeffrey Cleveland, that's politically unacceptable.
I agree. I don't want people. I do get messages from people, friends, family, and they say, it's okay if we have soft job growth, as long as the unemployment rate stays low. Well, bad news, everyone. If we have slow job growth, the unemployment rate tends to tick up, which is what we're seeing in the last few months. And I don't think 75,000 is politically palatable. I agree with you. So the risk here is additional rate cuts in 2026, and the bond market will start to sniff that out, I think.
So how do you think the Fed here, I mean, again, I'm looking at the WERP function. We're kind of going in today thinking one, maybe two rate cuts. Sure, I'm all over the WERP function. How do you think that maybe changes in the coming days?
I think you're going to get more priced in. In our view, if the unemployment rate continues to trend up, and in our forecast, we do have inflation moderating. I think that's important to note as well. The Fed, we have, in our base case, the Fed cutting 3 times in 2026. So WERP is probably underpriced at this stage. And that 4.6% unemployment rate bolsters that view, I think.
Well, let's jump ahead here. I mean, that's what Paul Sweeney wants, and I want, and Jeffrey Cleveland wants. Kent Manny's taking notes from Invesco over here. We'll get to Christina in a moment. But the bottom line, in 2 days, I get am I right? It's a legit CPI report on December 18th. Is that right, Jeffrey?
We get CPI on December 18th for November. So, I mean, definitely that'll be interesting to take in. We do think when we look at the main components of CPI, what we think will drive inflation in 2026, we think goods prices will cool off. We think non-housing services prices will also cool given the weaker labor market. And we do think housing has been a big thorn in the side of the CPI, the policymaker community. So we expect some relief in the housing component. So when we tie that all together, we do get core inflation trending back towards 2% next year. So that's kind of how we're looking at things.
Jeffrey, I mean, it's inflation again. We're going to hear some more inflation later on. We're hearing that maybe that cost of housing is coming down. How does that housing figure into just kind of inflation? Because for a lot of people, that's a big component.
Yeah, I mean, for the CPI, it's a big chunk. We're talking about a third of core CPI. It's a little bit less of an issue in core PCE, which is the Fed's preferred inflation gauge. But the data is slow and sticky, at least the government data. And we do see scope for the housing component of those indices to continue to cool off. That's good news. But I think it's more of the government data catching up with the reality on the ground. I think we've already seen in private sector metrics of rent and things of that nature a cooling in the housing component. But that should, people have said to me, we're sticky. Inflation is sticky. It's stuck at 3%. I think a portion of that is housing. As that cools off, core inflation will head back to 2%.